Hey Kenya, here's the big question. How much debt does our country really owe? And why should you care? By March 2025, Kenya's public debt hit over 11 trillion shillings. That's a number so big it affects everything, from the price of fuel at the pump to how much your government can spend on schools, hospitals, and jobs. But what's behind this huge debt? And is it a problem or a path to progress? In the next few minutes, we'll break it down, simply and clearly, so you understand what's happening, what it means for your wallet, and what's next for Kenya's economy. Stick with us as we unpack how much Kenya owes at home and abroad, why the government has borrowed so much, what risks this debt brings, and what the future could look like for all of us. Ready? Let's dive in. As of March 2025, Kenya's total public debt stands at about 11.36 trillion Kenyan shillings. Here's how it breaks down. Around 5.23 trillion shillings, or 46%, is external debt. This is money borrowed from foreign lenders. The remaining 6.13 trillion shillings, or 54%, is domestic debt. And this is borrowed locally, mainly through treasury bonds and bills. Why borrow so much? One big reason is investment in infrastructure. From the standard gauge railway to expressways and new ports, Kenya has taken on huge projects aimed at fueling future growth. These projects need cash up front, and borrowing is often the way to get it done. But borrowing isn't only for big projects. The government also borrows to cover budget gaps when revenues fall short. Local borrowing has increased sharply, with treasury bonds making up over 84% of domestic debt. Treasury bills, which are shorter-term loans, have also risen, a sign the government is managing some short-term funding pressures. The good news? The cost of borrowing locally has gone down. The 91-day Treasury bill rate has dropped from 16.7% last year to just 8.9% today, easing some pressure on government spending. To keep the debt sustainable, the government is favoring concessional loans, cheaper borrowing with better terms, shifting more to domestic debt to reduce foreign currency risk, digitizing tax collection to plug revenue leaks, and working with the IMF for financial support and transparency. But challenges remain. Over 60% of tax revenue could soon go just to repaying debt, leaving less for health, education, and job creation. There's also a risk that if the Kenyan shilling weakens suddenly, the cost of external debt will jump, making repayment even harder. So what now? Policymakers need to enforce strict borrowing limits and boost partnerships with the private sector. Investors should watch debt trends and government policies closely. And as citizens, it's important to demand transparency and engage in how borrowed money is spent. Kenya's public debt story is complex, but with smart management and united effort, there's hope for a sustainable future. Thanks for watching. Don't forget to like, share, and subscribe for more updates on Kenya's economy.